Hey guys, welcome to this week's video. So over the past weekend, markets were shaken by a sudden escalation in the US and China trade tensions. Trump flooded 100% tariffs on Chinese exports and the China threatened retaliatory moves. The impact was swift. The S&P 500 plunged 2.7%, the Nasdaq dropped 3.6%, and the Dow lost 878 points, which is equivalent to negative 1.9% in the single session. Analysts estimate that trillions in the market value were wiped out worldwide, especially in the tech sector, where mega caps were hit hardest. What if this isn't just another headline, but a reminder of how fast fear can flood the markets? So let's get into it. Today we are diving deep into the US-China trade war, but we are going to cut through all the noise because we are breaking down years of data to figure out the real link between all those scary headlines and what actually happens to the market. So let's kick things off with this recent threat, a potential 100% tariff. Now, this wasn't just another tweet. This was the kind of statement that sent instant shockwaves through global markets and basically put everyone on high alert. And that really gets into the heart of what we're talking about today. We've seen this back and forth for years now. So what's the pattern? What have we learned? And what makes the market totally panic? To figure that out, we've got to rewind the clock. Let's go all the way back to the beginning, 2018, where this whole trade war thing stopped being a what if and became a real, very painful reality. The first big move wasn't even aimed just at China. It was a protectionist play. 25% tariffs on steel, 10% on aluminium. The game was officially on. Now this is where the data gets really interesting. The market's fear didn't just grow. It literally doubled down once the fight got personal with China in March 2018. The S&P 500 took a 4% hit but bounced back in 3 weeks. By June, when tariffs specifically targeted China, the impact was twice as bad, an 8% drop that took almost 3 months to recover. So what's the big takeaway here? Lesson number 1, reality bites. When threats become actual tariffs, the impact is real. It's immediate and you can measure it. This wasn't just politics anymore. The conflict had a price tag and everyone knew it was just a beginning. Okay, so that was just the start. But things escalated fast. It stopped being just about tariffs and it turned into a high-stake drama full of negotiations, threats and surprises. Look at this timeline. September 2018, the fight widens, triggering a correction. Then boom, May 2019, a surprise tweet hikes tariffs again. By August, it wasn't just about tariffs anymore. We were in a full-blown currency war. When you dig into the numbers, something fascinating pops out. It wasn't the tariffs themselves that caused the biggest sell-offs. It was the drama. The shock of talks collapsing out of nowhere. That's what really spooked investors. When the first China-specific tariffs hit in June 2018, markets dropped 1.5% the next day. It was bad, but it was expected. Compare that to May 2019, when peace talks fell apart overnight. The S&P 500 plunged 2.4% in a single day. That brings us to our second pattern, negotiation drama. It proves that old Wall Street saying that market hates uncertainty more than bad news. You can price in a known negative, but you can't price in chaos. Jump forward to today, the game has changed. We've moved from an all-out brawl to a strategic chess match. The goal isn't just shrinking the trade deficit anymore, it's containing China's tech growth. The weapons are surgical, export controls, investment bans. The targets, AI, EVs, semiconductors, the tech that will define the future. Between 2017 and 2023, China's slice of the US import pie shrank 8%. Business shifted to Mexico, Vietnam, Taiwan as companies diversified supply chains. Since the strategy changed, so did the market's reaction. Headlines about the new tech restrictions barely dent the S&P 500 now. Instead, the volatility is concentrated. ASML's export license pulled. Semiconductors dropped, not the whole market. After all this, the initial shock the negotiation drama, the new tech battlefield. What's the big takeaway here? This table tells the story. We moved from pure panic, whiplash, to cautious adaptation. Now, recovery depends on which companies can adapt and build new supply chains. So, should you be afraid when the market dips during a trade war? Not necessary. Short-term panic is normal. It's liquidity leaving the room. But the data shows recovery has always followed. Each trade war-driven correction since 2018 fully rebounded within months. In other words, fear creates drawdowns, discipline captures rebounds. If you zoom out, volatility spikes like they aren't the end of a bull market. They are the test of who's patient enough to stay invested while everyone else panics. So how can you protect yourself before chaos hits? Start with signals. Every major trade war sell-off was preceded by 3 measurable shifts. Number 1, rising volatility indices. VIX spikes 5 to 10% days before headlines. Number 2, sector rotation into defensive assets, gold, utilities, and consumer staples. Number 3, drop in manufacturing PMI data below 50, signaling slowdown risk. Investors who track these indicators or automate alerts around them can de-risk early without emotion. Practically, this means structuring a portfolio that auto-balances. For example, a 70-20-10 mix, equities, defensive ETFs, and cash equivalents. All of these rebalance quarterly. And for advanced traders, using stop-loss rules tied to volatility levels or momentum filters will help you step aside before panic peaks. Because at the end of the day, it's not about reacting fast, it's about thinking smarter. Because what if the real edge isn't timing Trump's tweet, but designing a system that's already prepared for them? That's where smart money is looking. Data first, headline second. At Quantex, we call this preemptive discipline, using historical data, back-tested volatility models, and rotation analysis to understand how market digests shocks. It's not about predicting politics, it's about preparing probabilities. Because when you turn every single panic into a pattern, you stop reacting emotionally and you start thinking like an algo. So when the next surprise tweet hits, remember, the goal isn't to dodge every dip, it's to build a portfolio resilient enough to turn uncertainty into opportunity. So what's the bottom line here? The question isn't if the trade war will shake economy again, it's who adapts fastest. And that's the edge, not fear but foresight. Thanks for watching today's video. We're also exploring a new series called Backtrack Backtest, where we will deep dive into past market data from past historical events to uncover real patterns behind market reactions. So drop a comment down below and tell us which event you'd like us to backtrack and backtest next. Don't forget to subscribe and share this video if you find it useful, and join our Quantex community link down in the description below. I'll see you in the next one.